So hi there. In this short video I'm going to talk about how to make a cash flow forecast. But before I get into explain how to make one, I'll just sort of introduce it by explaining why it's necessary to have one. And sometimes it's probably more important for smaller businesses, and certainly those ones without a lot of cash in the bank, to plan and manage what cash you have. And you can, forecast for any period, and it does depend upon what you're actually forecasting as to how far forward. So if, for example, you're just doing your budgets and you're planning for next year for your business, then that would only need to be a short 12-month cash flow forecast, including your profit and loss account. But equally, if you are looking to raise investment, you may want to look at doing that for a longer period, possibly 2 and preferably probably 3 years. Bigger businesses do use them, and cash flow and profit forecasts are a great planning tool, and it gives you something to aim at, it gives you a target, but it also sets a structure in place so that you can look at and manage your costs and outgoings. So going through this article, I'm going to use the article as a background to my presentation here. So in summary, a cash flow forecast can help you to plan and forecast the sales you expect to make in the next 12 months. And that is probably one of the hardest parts of a cash flow, because to a certain degree it's quite easy to identify your costs because, for example, your rent is fixed until you move premises and so on. But trying to predict how many sales you're going to make and what that translates into cash, that's the difficult part. But that's one of the elements of a cash flow forecast. It also helps you to plan your costs and set your budgets for the next 12 months, or if you are forecasting for a longer period, it shows you what costs are going to be incurred for your business. And then as a result of that, it will allow you to assess your cash flows both in and out, and what your monthly bank balance will be at the end of each of your months, and to make sure that you remain within your spending limits or your overdraft facility if you have one, or making sure that your cash balance never diminishes to a point where it causes business problems. And effectively it sets your targets, something that you can look forward to achieve. So for example, with your sales, by setting those targets, that can be used for your sales team to actually hit those targets. So the first section of this, I'm going to talk about what software you can use. Now, most people tend to use spreadsheets or spreadsheet software, and if you click on the link within this blog article here, this will take you off to Wikipedia, and on there's an enormous list of spreadsheet software, from free ones to paid ones like Excel, and there's Visual Lotus and so on. So there's a lot of products out there. The alternative is to get software that is specific or specifically designed to do cash flow forecasts. And there's pros and cons of either. Now, of course, if you're going for specific software, then that's going to cost you. Whereas if you go for spreadsheet software, that can either cost you or it can be free. The downside of using spreadsheets is making sure that you get everything to balance, making sure that you include everything in the right place. So for example, your profit and loss account, if you have to account for VAT or sales tax, that's exclusive of that. On your cash flows, that's included. And of course, you've got to work out the difference between capital expenditure and revenue expenditure. And there's so many other things that you have to take account of. There's complex formulas and so on. So if you're proficient at that, obviously a spreadsheet is worthwhile. Alternatively, I would suggest you perhaps look at a specific type of software, and they can range anything from probably about 25 to 50 pounds right through to thousands of pounds. So of course you've got to pick your budget on that, and you've got to decide on, is speed of the essence, is your time more valuable? So therefore, by using specific software, this will save you a lot of time. And of course that does depend on the software you use. So I've already touched on this. So at the outset, you need to decide on a forecast period. But if you step back from that, I think what you need to decide on is what it is you're actually using the forecast for. So as I already mentioned, if you are looking to prepare a set of forecasts which is to look at your next 12 months, you're budgeting for your business, then 12 months is probably sufficient for that. However, If you're looking for investment, an investor to invest in your business, or you're looking to go to a bank for a loan or an overdraft, then I suggest that you're probably looking to do a 36-month forecast, which will include your cash flows and your profit forecast and a balance sheet at the end of each one of those that you could present to either the investor or the bank to prove that A, that you can afford to repay the bank loan, and B, you can afford the interest, and with an investor that he is going to get his money back at the end of the day, or the return that you're suggesting that he can get for his investment. So depending on the reason for your forecast or your cash flow forecast will obviously depend upon the length of period. And you can do that anything up to 5 or 7 years. But of course, the further forward that you forecast, the more difficult it is going to be to predict A, what's going to happen to, say, for example, your sales, but B, what's going to happen in the business environment in your particular sector. It's very difficult to plan. Beyond 12, 24, 36 months, it starts to get much more difficult. So looking at the income element of your cash flow forecast, which is the next step in this blog article. Now, as I've already alluded to, this actually is probably one of the hardest things to do. But if you look at it that you're actually going to use this as a target, as setting forward what you're actually going to try to achieve within your business, then I think it looks slightly different from that point of view. But when you're actually going about it, if you're an already established business, your starting point could be to look at what happened last year. And that's useful certainly from a point of view that if you've got cycles in your type of sales, so you may have seasonal variations in how many sales your business makes, so you might have more sales during the summer months or in the winter months or whatever it happens to be. So you need to pick those up. Some businesses like to start from a clean slate, to say, ignore what happened last year. I'm going to set out, this is what I want to achieve this year. Last year happened and let's look forward. But sometimes it's a very good starting point to have a look at what happened. But also you could look at that to actually take your business forward. So if, for example, you've got cycles or seasonal variations, you might want to start thinking about what other products you could introduce. Products that could perhaps complement or counterbalance those cycles within your business. So you could have some products that get sold more in the winter versus other ones. So when some drop off, the other ones increase. So you could use that to then predict or actually forecast introductions of new products and services. When you're actually looking at your sales forecast, you might want to start looking at your sales mix between your different product lines. You might want to start having a look at the profitability of certain product lines, and by doing so you could actually try and put more emphasis on the more profitable items and possibly even cease the non-profitable ones, subject to whether they're loss leaders or they are complementary to the more profitable type of products or services that you sell. You can use your cash flow forecast to do various what-if scenarios with your different product lines, and that's the beauty of it, is planning forward to say, well, okay, what if I sell more of this one or sell more of that one? What if I cut this one out? What's that going to, or how is that going to impact my profit? How is that going to impact on my cash flows? The other element to look at when you're forecasting forward your sales, particularly when you're looking at presenting this to a bank or an investor, if you've said that you're going to be increasing your sales by any degree, you've also got to make sure that all your other costs and all your related costs to that are aligned. So for example, if you're predicting a huge great sales increase but you haven't addressed that you need to do more advertising in order to get more leads in order to generate those sales, then your cash flows won't hang together. It may be that you're perhaps not increasing your advertising, but within your business plan and what you've actually going to be showing there is that you're going to be targeting to improve on your conversions. It could be that you're changing your pricing structure. It could be that you're focusing on increasing your average sale and things like that. But so long as you've got something to back it up in a written form or in a summary form, in an assumption summary behind to back up your forecasts, then that's fine. But make sure that everything hangs together. And while I'm on that subject, it's important to also look at, as your business expands, to look at what other overhead costs would have to reflect the increase. So for example, if your sales are increasing to a certain level, have you got enough staff to cope with that? Do you need to introduce new members of staff? Or in order to achieve that level of sales, do you have a sales team, and do you need to increase your sales team in order to sell more? Will your telephone be used a lot more, so your telephone expenses go up? Is your premises big enough for carrying stock, to carry that level of stock, to actually incorporate that increase, and or the staff? So it's important that you review each of your expenditures and make sure they align with where the business is going and increasing. Looking also at your sales, one of the things you need to make sure of is that certainly if you're a bigger business, or a business that is above the VAT threshold, or in your country sales tax, or possibly New Zealand, we do have New Zealand customers, and also Australia, is general sales tax, or GST. You need to make sure that on your cash flow forecast these amounts include the VAT or sales tax, whereas in the profit and loss account that it doesn't. And also at the end of the period where you've got VAT, that the outstanding balance is including on the balance sheet. Whilst talking about VAT or sales tax, the also important thing to do is you may have to split out within your cash flows different product lines, or if you sell into different territories. So for example, there are certain items that carry VAT or sales tax and certain items that don't. So you'd need to split those out onto different lines within your cash flow forecasts to make sure that the VAT or sales tax is accounted correctly. Also, for example, it's certainly in the UK, if you export, that becomes zero rated, so there's no VAT attached to that. Whereas if you sell locally within your country, there is VAT. So you need to sort of think about splitting these sort of items out on your cash flow forecasts. And equally, when you look at your profit and loss account, none of them will include VAT or sales tax. So it's important that you distinguish between the two of those. The other thing to consider when you're actually working out your cash flow forecast and splitting your sales out is in terms of how your customers pay. And this can range from anything from they pay you cash or on the day effectively. They might pay you on credit card, so of course you then got to incorporate any credit card charges. Or equally, some of your bigger customers, I know some very big customers do actually require longer term payment agreements. So it might be 60 days, sometimes 90 days. Whereas some of the smaller people might pay you in 30 days. So you need to incorporate all these different types of payment periods within your cash flow forecasts. So of course, the month they're sold would be included in your profit and loss account, and the timing of when the customer pays you will be when it is incorporated onto the cash flow forecast. And at the end of each period, any amounts owed by your customers would also then be included in your balance sheet. Now this might sound very complicated, and it does become quite complicated when you're putting a spreadsheet together, but most good pieces of specifically designed cash flow forecast software would make this process very, very easy indeed. So you'd only have to put all the numbers in and say whether it's vatable or not, and then all of the other numbers are taken care of for you on all the reports, profit and loss account, balance sheet, cash flow forecast, etc., etc. So you've got to make your decision as to which way you go. The second step to that, or your sales, is once you've got your sales, and if you're a business that has cost of sales, you can then incorporate those. But it's better to set out what sales you're going to make before you even attempt to look at what costs those sales would actually incur. Now it might be that you keep it straightforward and simple. You may have a straightforward thing of saying, well, okay, we make a 40% margin or a 50% margin or what have you. So you would just you could even do a formula on your spreadsheet to say, okay, if our sales are £1,000, we make a 40% margin, so therefore our gross profit is £400. However, you may want to go in a bit more detail, and there are reasons why you would want to do that, because it might be that certain cost of sales lines might be VATable or attract sales tax, and certain items might not. There may be you have direct labour costs. So if you run a factory, you may want to incorporate those. And those themselves have another interesting cash flow aspect versus profit and loss aspect, whereas certainly in the UK you have PAYE deductions. So the net pay paid to the employees is paid within the month, whereas the tax deducted, and there's national insurance deducted and national insurance on top of that cost, is normally paid in the following month. So you need to be aware of those type of entries. And any good software which is specifically designed for this purpose would do all that for you much more straightforwardly than having to think about all these things with a spreadsheet. But if you are putting a spreadsheet together, just make sure you think about all those different aspects. Of course, where this particular aspect becomes more important, where the splitting out of wages, is if you run a employment agency, because employment agencies, one of their biggest costs is wages. So there'll be a significant cash impact between when the net pay is paid and when the government element or the tax part is paid separately, which is a month later, and that can have quite an important impact on your cash flows. So if you are an employment agency, getting that element right is very important. Also, as with sales, where you are given payment terms from your suppliers, and these may be different and vary from supplier to supplier, you'll need to split these out. So there may be some that you have to pay cash or immediately. There may be some that give you 30 days, 60 days, and so on, depending on what you can do. So you'd need to split those out so they appear on your cash flow forecasts in the correct period, but of course they would appear on your profit and loss account when they're incurred. The other thing to think about in terms of your cost of sale is any stock movements. So you may want to think about stock movements from month to month. If they are going to be fluctuating, it may be that you have to build up your stock to take account of a particularly high demand in sales in a particular period or what have you. So you may need to take that into account in terms of your cash flow and how that impacts on your final bank balance. So step 5 in this is working out your overheads, or the below the line costs. And in some ways these are a bit more straightforward to work out, because your starting point, certainly if you're an existing business, would be to look at last year. So you could look at, for example, your premises costs. So you know what your rent is. If you've got a lease over a period of time and that's set, you can say, well, okay, that's going to be fixed and we know what that's going to be. It may be that over the period of your forecast you've planned an expansion and you may need to move. And when you're actually forecasting or working that or planning for that move, you may have to do a bit of research to say, well, okay, we need to move from this premises to this larger premises, and we think the rent is going to be this amount of money. Or alternatively, this might be why you're putting the forecast together for a bank. It might be that you're looking to purchase a premises. So therefore, all the cost and cash flow implications of a purchase of a premises need to be incorporated into the cash flow forecasts, including VAT if the building is VATable, and the receipt of any loan if you're borrowing, and then the loan repayments, etc., etc. I've already mentioned that you need to have a look at whether any of your costs will be affected by the increase in your sales. So have a look at what your costs are that are almost directly related. So it could be, so for example, your marketing and stationery costs would increase as a result of increased sales. You increase your sales, you're sending out more invoices unless you do, so there'll be a cost there unless you're doing that all online. If you have a brochure, the more customers you have, the more brochures you need to send out, so therefore that cost would go up. The more customers you have, there's potentially more interaction, so then more phone calls, so your phone costs go up, and so on. So it's just really having a think about how your costs will be impacted. And already mentioned, of course, if you increase your sales significantly, if a part of that increase is that you are going to increase your marketing, you'll need to affect that within your cash flows and profit forecast. I suggest that you do go through each of your overhead lines. So it may be that you can use this to incorporate renegotiations with your suppliers. It may be that you can reduce the costs from last year. It may be that you could actually change suppliers to get a better price for certain items that you purchase. It may also be an opportunity to renegotiate your payment terms, because of course, if you're needing some cash to do an expansion or buy a property or what have you, by renegotiating the terms with your suppliers is actually a free way of getting money or lending, if you like, effectively borrowing money from your suppliers, of course, with their agreement. Consider whether any of the costs are subject to VAT or sales tax or GST, because this will impact on your cash flows. And as I said before, you'd obviously need to reflect different numbers in your profit and loss account over the numbers in the cash flow forecasts. Also consider any new costs that you might incur. So for example, if you're purchasing a premises versus renting one, there could be different repair implications, there might be different insurance implications, and there may be other cost implications as a result of now being an owner versus being a tenant. There may be cost savings, you don't know, but it's important to look at not just what happened last year and what costs and repeating those and tweaking them up or down or what have you, but it's also having a look at to say, okay, we're going to be doing something slightly different, so therefore that might incur this additional cost. So we've already mentioned premises, and possibly that might incorporate within your expansion plans. But when you're looking at premises, look at, so if it's rented, rent, and then your rates or what's paid to the council, your repairs, anything, or your costs for heating, lighting and so on. And to a degree they will remain fairly standard, but there may be ups or downs. And then you need to look at all your other different types of costs, your marketing costs, your advertising, printing and so on. Then look at your communication and stationery costs, so telephone charges, internet charges, and don't forget to look at any mobile phone costs to be included within your communication overhead. Have a look at your professional costs like legal fees that you might have to incur, accountancy, bookkeeping and payroll costs. Also, if you deliver your products to your customers, and particularly if you do so and you're looking to increase the amount of deliveries, make sure your delivery costs within your cash flow forecasts reflect any increase. Sometimes another significant expense is insurance. It might be in premises insurance, it could include your vehicle insurance or your general insurance for the business. And make sure that this aspect is not overlooked and that you are fully insured, because guaranteed if you're not covered for something and something happens, that could end up being quite a big cost to the business. So once you have all of that, the great thing about having a cash flow and profit forecast is you've got your plan now. You know what your budget is, you know what your costs are, so if you keep within those costs, and as long as you make the sales that you're forecasting and your credit function works, so you get your payments on time, you pay your suppliers when you say you're going to pay them, then everything should work out for your business. Your cash flows will work, the amount of the bank will work, and you can rest easy that everything is going to work out for your business, certainly over the next 12 months. As with cost of sales, it's worthwhile looking at any payroll costs and splitting out your payroll taxes like income tax and national insurance in the UK, because of course this will impact on your cash flows. So if you've got a significant payroll bill, there's going to be an element paid in the month, and there's going to be an element paid in the following month under PAYE. And of course this total cost just gets included on the profit and loss account. So it's important to make sure you distinguish between those and split them out accordingly. Step 6 is other income. It may be that your business has some other income, and it may be, for example, you sublet your building, or if you own it, you let out a portion of it, or you may even have some investments. Just making sure that that income is incorporated within your cash flows and profit forecasts. And of course taking into account any VAT or sales tax within that too. Capital expenditure, step 7, is another important element to your cash flows. And of course, capital expenditure is more significant to your cash flow, certainly when you're purchasing, than your profit and loss account. So that would then get incorporated on your balance sheet, and then it gets incorporated into the profit and loss account in terms of depreciation. There's another calculation you have to work out and make sure that your formulas are correct, and that this ties back to your accounting policies that your accountant or yourselves even would have set for the business. So it's important to make sure you get the timing for the payment of the asset correct in your cash flows, to make sure that you know whether it's VAT-able or not, or sales tax or GST. And this is very important when you're talking about a large capital purchase. So the timing of the VAT. So if you account for your VAT on a quarterly basis, if you purchase that at the beginning of a quarter, you've got to wait a long time before you get the VAT back. So crucial timing like that to, if it works okay for the business, to make that purchase towards the end of the VAT quarter, so you only actually have the VAT element out of the business bank account for a short period of time, so you get that paid back to you very quickly. So you can use your cash flow forecast to plan those type of expenditures and how that will impact on your cash flows. Of course, if you sell any assets, this is when it would also impact your profit and loss account. So any profit or loss on the sale of that asset would be incorporated into the profit and loss account. And of course, the sale proceeds would then be incorporated in the cash flow forecasts. Step 7, taxation, is another element that be to take into account. So certainly if you're making profits, any business will pay tax on that. It's understanding the level of tax that your type of business will incur and what level of tax is paid on the profits that you're achieving. I wouldn't worry too much about getting this absolutely perfect or bang on. It's making sure that there's a provision in there. So for example, if you're a corporation, say corporation tax is running at 20% and you made £100,000 profit, it's providing for £20,000. Now of course, taxable profits and actual profits are sometimes different. So you may have certain add-backs and you may have certain deductions to get to your taxable profit. Now your accountant might be able to help you with this, or if you're an accountant preparing your cash flow forecasts, then of course you want to make sure that either if you're doing it on a spreadsheet or you've got specific software that you can cater for these type of things. But again, it is only a provision, but it's important that you have a provision in there, and sometimes if you slightly over provide is better than under providing or not providing at all. Now once you've got all that information in there, the next stage would be to choose the reports that you want. Now there are going to be two very important basic reports. The very first one is obviously your cash flow forecast. So your cash flow forecast is a summary of all your cash inflows and all your cash outflows. And it will be an incorporation of all the things that we've talked about. All your sales income, including VAT, all your cost of sales, including VAT, all your overheads, all your payroll costs, the amount paid to the government, VAT payments, loan repayments, capital purchases, sales of assets, and so on. And it would also incorporate any loans from banks or investment from investors. And at the end of it, it will give you a summary of what you're left with in the bank. But also, it's always a useful thing to have underneath your cash flow forecast a net loan summary, so you can have a look at what your net position is. The other key report is obviously your profit and loss account, which is a summary of your income less your cost of sales, and then your overheads, and plus any other income, which will give your profit or loss for the business. Following on from that, the other reports that I would always say to incorporate within your cash flow and profit forecast, probably number one I would choose is the balance sheet. I always think it's vital to include a balance sheet, because this is key to making sure that all your numbers work and that everything's in the right place. Because if you can get your balance sheet to balance, you know at the end of the day that your profit and loss is correct and that your cash flow forecasts are correct too. Another report that I also find useful is a trading report. And the trading report is a breakdown of your sales and your cost of sales in a little bit more detail. So it might show the split between your different product lines, for example. You might sell books, you might sell stationery, you might sell various lines, and you might want to split those out. And equally, your cost of sales, you might want to split them between your direct labour, your materials, and various other aspects. And this would be all detailed on the trading report, which would back up your profit and loss account and your cash flow forecast. Equally, I always think it's a good idea to have an overhead report. And by doing so, this means that on the main profit and loss report that is key to any forecast would only include a summary. It would include a total of your overheads, and it might show a total of your wages and salaries costs. It might show a total of your general overheads, and then maybe your financial overheads and perhaps your depreciation. And then the overhead report would detail those in much more detail. So if your general overheads would then be broken down between rent, rates, light, heat, telephone, etc., etc. So, and then that total will be shown across onto the profit and loss account. I also think a summary report or snapshot report is a very good thing to have. And on there, you would just have a very, very summarized profit and loss and a very, very summarized cash flow forecast. So, for example, the cash flow would be literally your income, your outgoings, and your net cash balance. Your profit and loss account would be just your turnover, your cost of sales, and a total for overheads and your profit or loss. And equally important, and on that summary report would be a break-even analysis or a break-even line to show that the break-even point of your business. If your business is going to be taking out loans, a loan report would be very useful to show a bit more detail. So on the cash flow forecast, it would just show you when you received the loans and the total loan payments, and on the profit and loss account would be any interest charges. And the loan report would give you a bit more detail behind that, like the loan period, any loan holidays, any lump payments, and all the detail behind it really, the interest rate and so on and so forth. Also, if you are registered for VAT, a VAT report is useful, which would back up any amounts being paid out of the cash flow. So if you pay your VAT quarterly, it would summarize the quarter's figures totaling up to the amount that gets paid and then hits your cash flow forecast. So it just gives you a bit more backup information, so that if anyone asks any questions about your cash flow and profit forecasts, you've got that information to hand. A detailed fixed asset report is useful too. So, on the face of the cash flow, you just see totals of capital expenditure, whereas the fixed asset report might split this out into a bit more detail between additions, disposals, and your depreciation information. I also like to add in for good measure an assumptions report, and the assumption report would give you details like the tax rate that the company pays, a bit more explanation behind your debtor days, how long you are saying that your customers are taking to pay you. Your depreciation policy also might be useful, and things like that. And maybe if you've got money held on deposit, the assumption for the deposit interest, or alternatively you've got an overdraft, the overdraft interest. I've made reference to the profit and loss account and talked about either making a profit or loss. And it may be that you're wondering, well, why on earth would someone prepare cash flow forecasts for a business that is in a loss-making situation? Well, actually, in some ways, it's more important to prepare cash flow forecasts if you're in a loss-making situation to make sure that your business is actually solvent, to make sure that you are going to be able to meet your obligations as and when they fall due. It may also be that you're a new business and you're just starting out. It may be that the first, second, or maybe even the third year that you're actually making a loss, and therefore this would be a reason for doing a longer period to demonstrate, certainly for investors or the bank, if you're getting bank loan finance for the opening period, that you actually are going to be turning into a profit. And in this particular case, the cash flow forecasts are important to demonstrate that the amount of finance, either loan or investment, is actually sufficient to carry you through the loss-making period. A few other considerations. If, for example, you're starting out or you're an existing business, and over the period it means that you're going to be going over the VAT threshold and need to register for VAT, it'd be important to have a look at the impacts of that on your cash flows and profit forecasts. The other thing is it might be that you factor invoice discount your sales, or you're considering to incorporate that within your business. It might be that you want to have a look at how that impacts on your cash flows. Certainly if you've got customers that pay you a long way down the road, having factoring or invoice discounting will accelerate when you receive that money, and that can have a really positive impact on your cash flows and help you to grow your business. But equally, you've got to bear in mind that it can be quite a big cost to the business, so you have to weigh that out, and a cash flow forecast would be ideal to have a look at that. We have already alluded to having a look at loans and hire purchase contracts, looking at these and how you fund your capital purchases. So armed with properly professional prepared cash and profit forecasts, you'll be able to make important decisions about your business. You'll be able to use the reports, and these will back up a business plan. So if, for example, you've written a business plan to take to investor or bank, the cash and profit forecasts, or the numbers, are there to support that business plan. Within the business plan, you might want to put your key numbers, and then the cash flows would support that information. There are other uses for preparing cash flow forecasts, which would include things like you want to have a look at the introduction of a new product or service, and to see how this impacts on A, your cash flows, and B, your profitability. And certainly if you're having to do any research and development or R&D, how those R&D costs are going to be financed, and look at how that will impact on your cash flows going forward. Do you intend to change something about your business, your customer payment terms, or putting your prices up, or maybe renegotiating your supplier payment terms, or perhaps you might change your product mixes, or perhaps your transaction values. All of these can significantly affect both your profitability and your cash flows, so you can have a look at all these. You may also want to perhaps look at the impact of starting to trade in a different country. Of course, the tax implications may be slightly different. There are other costs that you might need to start thinking about. Do you want to set up a site over in that particular country you're starting to trade with? So all the upfront costs of doing so would need to be incorporated into your cash flows. Staffing changes. This can have an impact on your cash flow. Sometimes you may need to staff up prior to actually launching something or going down another route or what have you, and you need to make sure that you've got enough cash to cover the initial outlay of staffing up before you start to reap the rewards of increasing your business. So whatever the reason is for preparing cash and profit forecasts, I think the overriding message I want to get across is that the whole process should be easy. It's very easy to get bogged down into the actual complexities of perhaps preparing spreadsheets without stepping back and actually making sure that you look at the most important aspect of it is actually getting the forecasts themselves correct, making sure you have the figures on the right reports and including the right amounts. But it should be straightforward. But more importantly, your reports must be able to hold up to scrutiny, but also that they represent a realistic forecast of what is achievable within your business. Something that does work well with our particular cash flow forecast software, Cash Forecaster, is our free price increase calculator tool. So if, for example, one of the things you are looking at within your cash flow forecast is you're putting your prices up, just go off and download that tool. It's within the business tools, and that will show you how increasing your prices will impact on your business, or what it will actually. It shows you two things. One is it will show you how many customers you can afford to lose at that increased price without actually being any worse off. It will also show you actually, if you don't lose any customers, how much your gross profit margin would increase. So, so I'd certainly suggest having a look at that, even if you aren't here to possibly invest in our cash forecaster software. And I hope that this article and this video presentation has been useful if you are in the middle of preparing cash flow forecasts. If it has been useful, or you would like some more help, you can either add a comment to the bottom of this blog article, or you can go off to our support forum, and we'd be more than happy to help you if you go into the support section of that and pose your question, and if we can answer it, we will do. But whatever the reason for your cash flow forecast, I wish you luck, and I look forward to seeing you soon. Thank you very much, and bye for now.